markets and specific stocks. Bansal Wire is the first management on the show today. The company reported a good set of numbers. The revenue surged by almost 54%, margins expanded as well. Stock holding up with a gain of almost 2.8%. Pranav Bansal, who's the managing director at the company, joins in now. Pranav, thank you for joining in. First up, what exactly was your volume growth in the third quarter? If you could detail that for us. And where does the capacity utilization of the company lie at right now? If you could give us a sense of the volume growth for the third quarter, the outlook here, and the capacity utilization.
Sure. So the third quarter has been quite eventful for us. We came up with a lot of new products, and definitely there was a lot of consolidation that happened within the group as well. Therefore, you see a good jump in revenue as well as EBITDA number. As far as volume is concerned, we were at about 90,000, 92,000 tons of volume in the last quarter, which was significantly higher by about 50-60% if you compare it with last year.
All right, and the capacity utilization for the new Dadri unit, because I believe a lot of this volume growth would have come on the back of increased capacity as well.
Absolutely. So the new Dadri unit, which was set to start within this year and is going as per plan, we are already at 25% kind of a capacity utilization. So out of the 92,000 tons, about 7-8% has come from Dadri, which is only a start. Dadri, as you might know, is a plant where we are looking at least 3.5 lakh tons of capacity, which has already been installed. Out of that, we are utilizing 20-25% already.
Pranav, firstly, good afternoon. Thank you for joining in. Now, what are you expecting in terms of volumes for the next financial year? There's a report from Investec which says that you will be around about 5.05 lakh metric tons in FY26. Do you believe that it is a fair assumption that the brokerage is making, or do you expect to be much higher than that estimate?
I think it's a fair assumption because we would already be at 6 lakh tons of installed capacity by the start of next year. So, and looking at our volume trajectory right now, if everything remains the same, we should be able to achieve those targets.
I have a two-part question. One is, as utilization at Dadri increases, do you see better margins? What's your margin metric that one should look at, either in EBITDA per ton or, absolute margins per se? If you could give us a sense of that for the end of this year and next year. And at the same time, if you could give us a sense of how your export contribution is likely to be. Last known, that number was close to 11.5%. You were tapping some export markets. So on margins and export contribution, what's the guidance?
So as far as export is concerned, although we took a dip 2 years back in export, which was growing at about 100% every year before that, we are now back on track, I would say. Absolute numbers also, there's a good increase in quarter 3, and the next quarter and the year ahead looks positive for exports. But with that being said, the kind of increase that we are looking at as a company, I would not say in percentage term export would be any better here. Apart from that, when we come to margins, the right matrix for us is EBITDA per ton. But even that varies because of the 5,000 different products that we today manufacture. All those products have a different kind of an EBITDA level and a different product share within our portfolio. Going ahead, we are looking at ramping up low carbon wires, which is relatively lower EBITDA margin products in terms of EBITDA. But in terms of our return ratios, they are similar. So for next year, our focus would more be on volumes and top line. Our margins might reduce slightly, but in absolute numbers, even they would grow.
You said your margins will reduce slightly. Would you quantify that? If you could give us a number, by how much?
It's hard to say today, depending on the product mix again, because it's all in percentage. In terms of absolute numbers, we are still looking at a good increase in margins.
Can you define good increase?
So if you look at our numbers or our volumes today, we are at about 90-95,000 tons. And for the next year, we are looking at 5 lakh tons of volume. So you will see a 20-25% jump in volumes for the next year. Although it would not 100% correlate to EBITDAs, but I mean, it should give you a fair indication of where we are looking at.
So the EBITDA will grow just about in line with the volume growth, as against further than it, or maybe lower than it as well, or maybe about 80% of that, roughly, because there would be higher contribution coming in from lower margin products.
Yes, absolutely. So therefore, EBITDA might not increase at the same pace as revenue, but there would still be an increase.
One final question from my end, Pranav. Your finance costs have moved to around 7 crore rupees a quarter. You had earlier mentioned that you would become debt-free post the IPO. Now that your expansion plans are coming into place, are you planning on taking on more debt, or do you expect that finance cost to remain at that level as 7 crores a quarter, or do you expect that to trend down?
So actually, the current finance cost is also increased only because of revenue numbers. We've done a 35% increase in our revenue because of the consolidation also that has happened within the group. Going forward, there is no major capital expenditure that we have planned. The main capex was for the Adari, which we have already incurred. So there is no major capex that we look at in the next 1.5 years. If there is anything, I am sure we should be able to fund it with internal accruals and a very reasonable amount of debt.
You said low carbon will increase in its contribution. It's currently close to around, what, 57%? How does that product mix of the company change over the next couple of years? And what's your targeted return ratios? Because the first half you've done 17% ROE, 23.5% ROC. While it's a low margin business, it's a high return ratio business. So where do you look at your product mix and return ratios?
So, in fact, this is the right matrix for us to quantify our margin. We look at our return ratios more than the percentage of EBITDA or per ton EBITDA that we make, because that's the only thing that really matters, right, at the end. So, our return ratios is something that we focus on every day. And even for the year ahead, I would say we are looking to expand those further, whether it is ROC or anything else.
And, you are giving us directional indicators. We're looking for some ranges as well. You said that, yes, EBITDA will not increase as much as volumes, 20-25%, 5 lakh tons plus the volume that you're talking about. But if you could give us a sense, would we see mid-teen sort of growth in EBITDA? Would we see a couple of 100 basis points improvement in return ratios? Just directionally, if you could give a sort of range to the street as well, that'll be great before we let you go.
So our target for ROC is to always remain above 20%.
Okay.
Which is what we are aiming for the next year. As far as EBITDA is concerned, it will depend a lot on the market situation there. Definitely, we've taken a call where we do not want to sacrifice any volume growth because of slight margins. So we are ready to compete on margins front, but to gain on volume. Therefore, there should be some decrease in per ton EBITDA as well, but of course compensated by higher volumes.
All right, Pranav, thank you so much for sparing time and joining us today. Wish you good luck on the road ahead for the company. That was the management there of Bansal Wires, 4% higher on the stock after its results at 414. Time to take a short break, but before we do that, here's some good news for our viewers. India's business news leader is now a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips, as Mangalam is doing so just right now. You can download the app just like he has from the Apple Store or your Google Play Store, or just scan the QR code that's just come up on your screens. Take a short break, back on the other side.